Let's go ahead and move on to options to avoid foreclosure. Options to avoid foreclosure. First of all, there are several. We have refinancing. We all heard of loan modifications. There's forbearance, deed in lieu of, lease in lieu of, and finally short sales. Refinancing. H.A.R.P, the government's Home Affordable Refinance Program, has some specific requirements for you to qualify for. So not everybody can qualify for the H.A.R.P program. Number one, it has to be your principal residence. Number two, it can only be 1 to 4 unit home. It can't be an apartment complex. Number three, the home loan has to be owned or guaranteed by either Fannie Mae or Freddie Mac, the government-sponsored entities that we spoke of earlier. Number four, you have to be current on your loan for the past 12 months, which I don't know, you don't have to show your hands, but think about it. How many really are in this market current on their loan for the past 12 months? No 30 days late. Not very many. So you can already see that this program doesn't really help everyone. Number five, you have to have sufficient income to support the new payments. Even if you are allowed to get the Home Affordable Refinance program, you still have to qualify for the new payments, and the new payments are not that much lower than your current payments. And number six, your first mortgage does not exceed 125% of the current market value of your home. Now, right there, number six, 125% of the current market value of your home. When home prices have gone down 50 to sometimes 60% in certain areas, as you can see, the H.A.R.P program is really not a viable program for a lot of people. The second thing we all hear about, loan modifications. Everybody's heard of loan modifications. The government is pushing loan modifications. The banks are pushing loan modifications. The most popular loan modification program is the H.A.M.P program. H.A.M.P stands for the Home Affordable Modification Program. It's put on by the government. The H.A.M.P program is, again, has to be on your principal residence, 1 to 4 unit home again, has to be owned by Fannie Mae or Freddie Mac. The amount of the first mortgage has to be equal to or less than $729,750. Number five, you're having trouble paying your mortgage, which that's a given to me. If you're looking to modify your home loan, it seems to me that you would be having trouble paying your mortgage. Number six, your payment is more than 31% of your gross income. More than 31% of your gross income. And then number seven, you got your current mortgage before January 1st, 2009. So if you bought a home after January 1st, 2009, you're not eligible for this program. Just a little note though, at the bottom, H.A.M.P's success rate is currently between 1/4% to just under 0.5%. That's how many people this program is helping. They had big dreams, very small reality. It's just not working. Let me go back and speak a little bit, because before we started, you were asking a question, and I'll go ahead and answer that now. Modifications. Why would a bank not want to modify a home loan? Well, first of all, if the bank has insurance in place, there's no motivation for the bank to modify a loan, because if they foreclose with the insurances in place, they stand to make more money. And we'll talk a little bit more about that when we get to the question and answer period after the seminar is over. But imagine if you had a car and you were selling it to somebody, your neighbor, and your neighbor said, I don't have the money to pay you right now, but I'll pay you $300 a month. And you say, okay. And then you take out insurance that says, well, if this guy stops paying, I get my car back, and the insurance kicks in and pays me the money I lost. So the guy next door all of a sudden loses a job and can't pay you. So he comes to you and says, can I pay you $50 a month? And you're like, no, I've got bills to pay. You agreed to $300. Should I drop it to $50, or should I go ahead and take the car back and let the insurance pay me the money? And that's what happened. Come on in. So it doesn't make sense for the banks to do loan modifications because they stand to make more money doing they stand to make more money doing a foreclosure. Now, forbearance. Forbearance is a special agreement between the lender and the borrower to delay a foreclosure. Typically, it's for temporary financial problems. So a forbearance, sometimes forbearances will add the bulk of the money onto the end of the loan, and you make a smaller payment for 3 months, sometimes up to 12 months, and then the payment goes back. Forbearance is good, again, for only a temporary financial problem. Yet you have to qualify with your bank for forbearance. So sometimes, actually many times, a forbearance isn't a viable option. Deed in lieu of. Deed in lieu of. A lot of banks talk about deed in lieu of. The owner voluntarily deeds their property, signs their property back over to the bank in exchange for a release from all obligations under the mortgage. However, with the deed in lieu of, you still have to qualify for the deed in lieu of. If you're unable to, you have to prove if you're unable to make payments on your house. So you have to submit all your financial information to the bank for them in order to approve a deed in lieu of. And by the way, deed in lieu of, very low percentage of those are actually occurring right now. There's also another program called a lease in lieu of. This is actually more popular than the deed in lieu of. This is after you've exhausted all other alternatives. You have to qualify again for the deed in lieu of. You have to provide all your financial information to the bank first. But in the first 9 months of 2009, Fannie Mae executed just under 2,000 of these deed in lieu of deals. Out of hundreds and hundreds of thousands of foreclosures, only 2,000. And this is where you're allowed to lease the property that you're losing in foreclosure. Lease it back from the bank. Freddie Mac has been offering leases to former owners on a month-to-month basis, but again, that's only a month-to-month basis. It's not guaranteed. And this happens after foreclosure. Now we come to short sale. Short sale is a sale of real estate in which the bank accepts sales proceeds that fall short of the balance owed on the property's loan. In other words, they agree to take less for what they're owed. H.A.F.A, the Home Affordable Foreclosure Alternatives Program. This is the government program, H.A.F.A, Home Affordable Foreclosure Alternatives. It follows along with the H.A.M.P program, the modification program that we spoke of earlier. First of all, again, it has to be your principal residence, has to be 1 to 4 unit home. Again, it has to be a home loan owned by Fannie Mae or Freddie Mac. Same amount, $729,750 for the first mortgage. You have to have trouble paying your mortgage. Your payment, again, has to be more than 31% of your gross income. And again, your current mortgage has to have been taken out before January 1st, 2009. There's some additional requirements for H.A.F.A. H.A.F.A falls after you either do not qualify for a trial mortgage modification under H.A.M.P, or you don't successfully complete the trial period for your modification. In other words, you've got a modification under H.A.M.P and you fail to make all your payments because the payments are not that much lower. Or 3, you miss at least 2 consecutive payments during your H.A.M.P modification period. The next step after that is you're referred to H.A.F.A for a short sale by your bank. Now, again, H.A.M.P, the modification program that you have to qualify for, if you don't qualify for it or you fail to properly make the payments like you're supposed to under the program, your bank will automatically refer you over to H.A.F.A. And then, at that point, you'll contact a realtor and short sell your home, or you'll go through foreclosure. Just recently, January of 2011, Governor Schwarzenegger signed into law the California Senate Bill number 931. California Senate Bill 931 prohibits a deficiency judgment for the first trust deed. So now if you and your bank agree to do a short sale because of this new law, the bank will not come back after you now for a deficiency judgment. In other words, they will not come after you for the difference that they lost because they agreed to do a short sale. In the past, they could come back, and so most people were saying, why should we do a short sale? If we're going to have to pay for the money anyway, if they're going to come after us with a judgment against us, why bother doing a short sale? Well, now because of this new bill, Bill number 931, in California, the first trust deed will no longer come after you for a deficiency judgment in a short sale. There's another thing called strategic defaults. Strategic defaults is something that the banks, the government, and the real estate industry has no clue about how many of these are out there. A strategic default is when you live next door to John. John is losing his home to foreclosure. John sells his home in a short sale for half of what you paid your house. But you don't have a problem paying your payments. But you look next door and you think, well, wait a minute. I could buy a house for half the amount and get the same large house as I have. Why would I want to make the higher payment? I'm going to go ahead, buy another house, and let this one go to foreclosure. It's happening all over. And I'm sure there's people out there that are considering it right now. It's not included in any foreclosure numbers that they publish. There's an unknown number. It's a hidden shadow inventory. And it really hurts the market because people who can afford their payment don't think it's fair that the next door neighbor bought the same floor plan for half the amount of money they bought it. So they decide they're going to go out and buy another house and let theirs go to foreclosure.